Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We've been coming to you live from the Singapore Fintech Festival, and joining me on set, we have Carlo Las Maris. He's a co-founder and COO of Hummingbot. We're going to take a look at liquidity mining, and as you know, in the cryptocurrency space, liquidity is always an issue in the cryptocurrency markets. Carlos, it's great to have you. As always, I guess the question is, why is liquidity continuing to be a problem in crypto?
Sure. Thanks for having me on as well.
You're welcome.
So I think what we've seen over the last 3 years, there's obviously been a huge rise in the number of exchanges out there, also a number of token issuances. So what we've seen is there are now around 21,000 unique markets, actively traded markets. And we haven't seen an equal rise in the number of market makers to kind of offer liquidity for those different markets. So what we've seen is a large concentration where the highly active, there's a few limited tokens which are actively traded, but then you have this big long tail of assets which hasn't been addressed with market makers just can't service. And why that's a problem for token issuers and for token projects is it could be a barrier for adoption. So if you're a token issuer or token platform, if it costs or if users lose 2-5% of value just to acquire your tokens, that obviously creates a lot of friction for them to even get your token in the first place to use on our platform.
Right, so before we get into what liquidity mining is, I mean, do you think the proliferation of markets and how fragmented it is, that's always going to be a roadblock for institutional adoption?
Exactly.
What happens there? I mean, do you eventually see consolidation in that space? What needs to happen to make it look less fragmented?
I think there'll be a few ways. I think one of our approaches is we're actually trying to make it so that all the markets trade more in line. So why we introduced kind of a Hummingbot or open source trading platform, it's a way to kind of unify the market. So we do different kinds of strategies that bring different liquidity across less liquid exchanges and kind of bring markets more in line. So that way it will kind of mitigate some of the fragmentation impacts of the different price disparities by using different strategies that kind of bridge the more active trading with the less active trading. We kind of consolidate amongst the levels to some degree. But I think in the longer term, yes, I think there will have to be some consolidation. I think right now, just because there's a lot of different regulatory jurisdictions that are kind of the source of some of this fragmentation, I think we'll have different centers, but I think in the long run, some of the small changes may not be sustainable.
All right, so what is liquidity mining?
Sure. So that's kind of a concept, an approach to liquidity that we introduced. So we created Hummingbot, and the idea there is if we enable anyone to become a quant or algo trader, so we basically access this potential previously untapped source of market making as well as inventory. So we have the general public. So right now, where typically market makers are just a limited number of quant hedge funds that can provide these services, by giving everyone the ability to market make, we basically unlock this whole potential pool of market makers. So what liquidity mining is now that we have this potential army of market makers, how do we actually harness that potential? So what liquidity mining is, it's a way to coordinate the different users of Hummingbot who can provide market making and align them with exchanges and token issuers who are the folks who need liquidity. And so what liquidity mining is, it's a way to incentivize so exchanges and token issuers, they can run liquidity mining campaigns where they offer rewards to users, to folks like Hummingbot users to provide liquidity in the markets, and they can kind of customize the different metrics to solve for.
So this is interesting. It's community-based market making, which is a very interesting and new concept. Do you think that's a better alternative to hiring professional market makers?
I think it is. There's a number of reasons for that. One, there's just not enough quant hedge funds out there. And so what we're seeing, if you've spoken to any token issuer exchange, what you'll see is there's a few problems with that. One is they charge really high fees. They typically require inventory to market make, and they're also operate as a black box. So there's no way to really tell how well they're doing their jobs. So the problem that's not sustainable, whereas only the large projects have access to the amount of spending on market making, I think decentralized is a better way approach, because for one of the limitations for market making is inventory. So either the token issuers or the quant hedge funds have to use their own inventory. By having a decentralized pool of market makers do that, we're able to access inventory from anyone in the market who wants to do that. And also, quant hedge funds and professional market makers, I mean, they have really high cost structures. They have high profit hurdles they'll need to meet for their different partners, their investors. Whereas,
but they're also assuming risk.
Yes, but in this case as well, I think like the bridge, the gap between, so if we have a decentralized market maker or an individual do market making, like their cost hurdles may not be that high. So they may not need to pay all these limited partners all these X amount returns. But they can still assume that risk at a level where it makes sense for them to take on that risk, but they don't have like the cost structures of like a professional hedge fund, as well as the limitations of constraints of inventory. Because right now, quant hedge funds, because there's only a few of them, they had to kind of pick and choose how they allocate their assets and their resources. Whereas if we potentially tap the general market, we can have some users who may be open to like providing services for like smaller, underserved markets, whereas professional market makers just don't have the bandwidth or interest because it doesn't make sense for them because the market is too small.
All right, Carlos, thanks so much for joining us at the Fintech Festival. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.